Here are the STC Crunch Time Facts for the Series 65, Chapter 13. The cash value of a variable life insurance policy is determined by the performance of the subaccounts within the separate account. The variable annuities payments are based on the AIR assumed interest rate and the performance of the separate account. An equity-indexed annuities return may be based on the point-to-point method, which is based on how much the index, like the S&P 500, changed between two dates, so like the start and the end of a period. An equity-indexed annuity has a floor of 0, so a return can't fall below 0. Whole life insurance is considered ordinary insurance. It's permanent, it has fixed premiums, and offers fixed benefits. A real estate limited partnership passes through both losses and gains to its partners. However, a REIT doesn't pass through losses to its shareholders. Blind pools or non-traded REITs don't always invest in real estate. The portfolios of REITs must derive 75% of their income from investments in real property, and 75% of their assets must be invested in real estate. REITs must pass through 90% of their income, but cannot pass through losses, so it's a pretty high percentage. Once a client has annuitized her annuity, it cannot be rolled over into an IRA. A form that's filed with the IRS on behalf of a limited partner is Form K-1. I think this was it in sign language, K-1. When a term life policy is extended, its premium will increase. Both mutual funds and hedge funds are pooled investments. A mutual fund's net asset value is its assets minus its liabilities, and then underneath that is the number of shares outstanding. Trailers are small yearly payments to the salesperson for keeping you in the fund. The trailers that are paid to mutual fund salespersons may be derived from 12b1 fees, which are levied against the fund's assets. For a no-load fund, fees are assessed annually. Mutual funds, open-end funds, are sold exclusively in the primary market. They're not exchange-traded. Open-end funds have fluctuating capitalization. They issue and redeem shares daily. Closed-end funds have fixed capitalization. They only issue shares one time. Closed-end funds are marketable and trade on the exchanges. Closed-end funds can be sold at a premium or discount to their net asset value. Exchange-traded funds, ETFs, are registered as investment companies and trade on the exchanges, of course. ETFs share prices are based on the supply and demand for the shares on stock exchanges, just like closed-end funds. ETNs, so exchange-traded notes, are unsecured bonds and have credit risk. Alright, only 3 more. Gold exchange-traded funds provide returns that are uncorrelated with other types of investments. Leveraged exchange-traded funds increase the gains and losses due to the fund's leverage factor. Direct investments in real estate, like buying apartment buildings, can provide tax benefits that other investments don't. Hope this helps.